What if the move you thought made you the strongest buyer in the room actually made you the most vulnerable? Most people walk into a home purchase convinced that putting down more money is the financial responsible choice. It feels right. It sounds smart. Your parents probably told you, your coworkers confirmed it, and ChatGPT reinforced it. But here's what nobody tells you. The buyer with 5% down and a full savings account is often in a stronger financial position than a buyer with 20% down and nothing less. Sit with that for a second. Before we go any further, let me introduce myself. I am Kevin Martini, a certified mortgage advisor and producing branch manager, NMLS 143962, with the Martini Mortgage Group at Gold Star Mortgage Financial Group Corporation, NMLS 3446, Equal Housing Lender. This podcast is for educational purposes only and is not legal or tax advice. If you're listening to this right now, you've probably been doing the math in your head for a while. You watched your savings accounts grow. You tracked home prices. You had the internal debate. Do I wait until I have more down or do I move now? You Googled it. How much should I put down on my house? And gotten 17 different answers that somehow all sound logical. You're not confused because you're not doing the work. You're confused because the advice you're getting was designed for a different market, a different rate environment, and honestly, a different version of home buying than the one that actually exists right now. And somewhere underneath all of these questions, you haven't been able to answer, am I actually making the financially smart move here, or am I just doing what feels safe? That's exactly what we're going to untangle here today in the Martini Mortgage Podcast. And I'll tell you up front, there's a specific number I want to share with you before this episode ends, and a number that completely changes how most home buyers think about the decision. Stick with me. Here's where the confusion starts. Most of the advice around down payment treats it as a simple mathematical problem. Put down more, lower payment. Put down 20%, avoid PMI. Simple. And that logic isn't wrong. It's just incomplete. Because the question isn't just how much goes into the transaction. The real question is what happens to the cash that stays behind? A down payment is a one-time transfer. Once it moves into the transaction, it's gone. It becomes equity. And equity, as real and valuable that it is, cannot pay for a water heater that fails 3 weeks after closing. It can't cover an HVAC replacement. It cannot absorb a job shift or an unexpected medical bill during the first year of homeownership. What covers those things is liquidity, cash reserves, financial breathing room. And this is where most buyers quietly trade one for the other without ever realizing the exchange that they actually made. Let me give you two paths. And I want you to honestly feel the difference between them. Path A, okay, is you stretch, you pull from savings, you delay other financial goals, and you get to 20% down. You eliminate PMI, your monthly payment is lower, you feel like you made the responsible move. Then, 3 months in, the roof needs attention, or the HVAC, or something you didn't see in the inspection. And suddenly you're researching credit cards to fix an asset you already own. That's not stretch. That's vulnerability dressed up as discipline. Let's talk about Path B. You put 5% or 10% down. You pay PMI. Your payment is slightly higher, but you close with 3 to 6 months of reserves in attack. When your life arrives unscheduled, and it always does, you absorb it. No panic. No debt spiral. You're a homeowner who has made a calculated decision and built a financial cushion to back it up. Here's what nobody talks about with Path A. In Raleigh and the Triangle market of North Carolina, lenders actually look at your cash reserves after closing, not just in your down payment. A buyer who emptied their account to hit 20% down may pass the debt to income check and still red flags on the reserve review. And this is where people get it wrong. They optimize for the number that feels impressive and miss the number that actually protects them. Now, I mentioned a number earlier. Here it is. If reaching 20% down requires you to pull $40,000 from your savings and PMI on the loan runs $250 a month, it takes 160 months. That's over 13 years just to break even from those depleted savings. That's before accounting for the $40,000 could have earned sitting in a high yield account. That's before factoring in what you have covered in home repairs. That's before the math gets personal to your income, your loan structure, and your property. And here's the thing about PMI that most buyers don't know. We're going to get that in just a moment. So, because what I'm going to share is going to change everything. Here's the clarity I want you to walk away with today. A bigger down payment gives you 3 things: lower payment, smaller or eliminated PMI, and a reduced loan balance. Those are real benefits. None of them are automatic reasons to do it because none of them account for what it costs you to get there. PMI on a conventional loan is not permanent. Once your equity position equals 20%, you can request the cancellation. In the market like Raleigh, North Carolina, where appreciation has been very consistent, some buyers hit that threshold faster than they expected. The PMI cost they worried about ended sooner than the math initially suggested. The goal isn't to minimize the down payment. The goal is to maximize it either. The goal is to find the structure that gives you the lowest payment you're comfortable with, the reserves you need to stay stable, and the confidence to walk into homeownership without being one broken appliance away from a financial emergency. That's not a generic answer. That's a math problem specific to your situation, and it's almost never looks the same twice. This is exactly why the home loan first strategy matters. Most buyers go house hunting first, fall in love with the property, and then figure out the financing. By the time they run down payment scenarios and emotionally attached to the house and making financial decisions under pressure. The home loan first strategy flips the sequence. You understand your numbers first. You know exactly what different down payment structures do to your payment, your reserves, and your approval before you even walk through a door of a house to preview. And that connects directly to what we call a same as cash mortgage approval. When your financing is already structured and committed, underwritten, not just pre-qualified, you walk into an offer situation with credibility of a cash buyer. Sellers know you're real. Your offer stands out, and you made the decision about your down payment from a position of clarity, not pressure. That's not a sales pitch. That's just the difference between reacting and being prepared. Here's the question that most buyers never think to ask, and they answer might genuinely surprise you. Ask yourself, if I put down the amount I'm planning to, and I had a $15,000 emergency 6 months from now, how would you handle it? If the honest answer is, I'm not sure, that's data. And that data matters more than down payment percentage ever will. Let me leave you with a few questions. And I mean it. Actually sit with these. Number one, do you actually know what your monthly payment looks like at 5% down versus 10% versus 20%? With the real numbers, your price range today's rates too. Number two, after closing, how many months of reserves would you have left? And is that number something you feel confident with if something unexpected happened in year one? And number three, have you run the PMI break-even math for your specific loan? Or have you been just avoiding PMI based on a number you've heard somewhere that wasn't built for your situation? If any of those questions made you pause, that's not a problem. That's actually the right place to start. Clarity creates certainty, and certainty creates power. If you want that kind of clarity for your situation, the real numbers, your scenario, your decision, you can reach me, Kevin Martini, directly at 919-238-4934 for a no pressure, just a conversation. If this episode gave you a new way to look at the decision, share it with someone who's sitting on the fence. They deserve to hear this before they make a move they can't reverse. And please subscribe so you don't miss what's next.